Imagine waking up Monday morning to breaking news. A major global bank has failed over the weekend. Not a small community bank, a systemically important financial institution, one of the names you see on every corner. And at the exact same time, silver is trading at $79 per ounce, having just completed a 167% rally in 12 months. The markets are closed. Nobody knows which banks are exposed. Nobody knows how deep the derivatives losses go. And by the time Asian markets open in a few hours, the entire financial system could be facing its biggest test since 2008. This isn't speculation. This isn't fear-mongering. This is a scenario analysis based on current market conditions as of December 28, 2025. And the mathematics are genuinely terrifying. Right now, the four largest banks in America hold over $5 trillion in notional value of precious metals derivatives. Silver just breached $79. Two banks have already failed this year. And the derivatives exposure, the physical supply shortages, and the banking sector stress are converging in a way that hasn't happened in modern financial history. So let me walk you through exactly what could happen, not what will happen, not predictions, but what the actual mechanics look like if these dominoes start falling. Because understanding the system is the only way to evaluate real risk versus manufactured panic. Let's start with where we actually are. December 27th, 2025, silver surged 10.21% overnight to reach an all-time high of $79.25 per ounce. Then on December 29th, it pulled back to around $72. That kind of volatility, those $9 swings in a single session, that's not normal. That's not healthy market behavior. That's what happens when physical supply constraints meet speculative momentum in thin holiday trading. Now, here's what most people don't understand about the silver market. The annual global production is around 850 million ounces. Annual demand is 1.16 billion ounces. That's a structural deficit of over 300 million ounces every single year, and it's been in deficit for 5 consecutive years. Where does the shortage get filled from? Existing stockpiles, recycling, and derivatives that settle in cash instead of physical metal. But here's where it gets interesting. China, which controls 60 to 70% of global silver output, just implemented export controls on January 1st, 2026. Companies now need government licenses to export silver. Only large state-approved firms producing at least 80 tons annually with $30 million credit lines qualify. That effectively shut down hundreds of smaller exporters overnight. The global supply just got tighter. A lot tighter, and the market is responding exactly how you'd expect. Physical silver is trading at a 7% premium for immediate delivery compared to future contracts. That's called backwardation, and in commodity markets, backwardation is a red flag signal of immediate supply stress. It means people need metal now, and they're willing to pay a premium to get it. Not next month, not next year, right now. Meanwhile, in the banking sector, we've seen 2 bank failures in 2025. Pulaski Savings Bank in January and Santa Ana National Bank in June. Both were small institutions. Combined assets of about $113 million. Nothing systemically important. The FDIC handled both failures smoothly. Depositors were protected, no contagion. Orderly resolution. But let's zoom out. The banking sector is under pressure that doesn't make headlines every day, but is building steadily. GDP growth in the United States has stalled at 1.4% for 2025. That's half the growth rate of 2024. Net interest margins, the difference between what banks earn on loans and pay on deposits, have compressed to around 3%. Deposit costs are stuck at 2.03%, more than double pre-rate hike levels. And customers aren't accepting lower returns, even though the Federal Reserve has started cutting rates. Here's the problem. Banks make money on the spread. When deposit costs stay high, but loan rates drop because the Fed is cutting, that spread gets squeezed. And a compressed spread means lower profitability. Lower profitability means less cushion to absorb losses. Less cushion means vulnerability.
Now add in another factor: unrealized losses on securities. Banks hold significant amounts of government bonds and mortgage-backed securities. When interest rates rise, the value of those securities falls. As of mid-2025, the banking sector is sitting on substantial unrealized losses. These don't show up on financial statements until the bank sells the securities, but they represent real economic losses. And if a bank faces a liquidity crisis and needs to sell those securities, suddenly the unrealized losses become very realized, very quickly. That's what happened to Silicon Valley Bank in 2023. A bank run forced them to sell securities at a loss to meet deposit withdrawals. The losses wiped out their capital. The FDIC stepped in. It was the second largest bank failure in U.S. history. Now, let's talk about derivatives. This is where it gets complicated, but stay with me because this is the critical piece. The four largest banks in America, JP Morgan Chase, Bank of America, Citigroup, and Goldman Sachs, collectively dominate 90% of all bank-related precious metals derivatives. These positions are reported in notional values. Notional value is the total value of all the contracts, not the amount of capital actually at risk. That's an important distinction. For example, if a bank has a derivative position with a notional value of $1 billion, the actual at-risk capital might be a tiny fraction of that, maybe 1 or 2%, depending on how the position is hedged and margined. But here's the catch. When markets move violently, when volatility spikes, those margin requirements can change instantly. And if a bank is on the wrong side of a big move, they get margin calls. They have to post more collateral, fast. In commodity derivatives, especially precious metals, there's another layer. Physical settlement versus cash settlement. Most futures contracts settle in cash. The buyer and seller just exchange the difference in price. No physical metal changes hands. But some contracts, especially when supply is tight, get settled physically. The buyer actually takes delivery of the metal, and here's where the nightmare scenario starts to take shape. If physical silver is in shortage and prices are spiking, and suddenly a lot of contract holders decide they want physical delivery instead of cash settlement, the banks that are short, those contracts have a problem. They need to deliver physical metal they might not have, or they need to buy it in the market at whatever price they can get. If the market is illiquid and everyone wants metal, the price can spike even higher, which triggers more margin calls, which forces more buying. It's a feedback loop, a short squeeze. The London Bullion Market Association, the LBMA, reported that London vaults held 27,187 tons of silver as of the end of November 2025. That sounds like a lot, but when you convert it to ounces, that's about 870 million ounces. Remember, annual demand is 1.16 billion ounces, and the COMEX, the main futures exchange in New York, has open interest representing delivery claims on roughly 900 million ounces. If even a fraction of those contracts demand physical delivery, available supply disappears fast. Now imagine this scenario. It's Friday afternoon, December 27th, 2025. Silver has just spiked to $79. A major bank, let's call it Bank X, has significant short exposure to silver derivatives. They're hedged. They've got counterparties. But the move is so fast and so large that their hedges don't perform as expected. Maybe a counterparty is struggling and can't meet their obligations. Maybe the physical market is so tight that buying metal to deliver is impossible at any reasonable price. Bank X gets massive margin calls from clearinghouses. They need to post billions in additional collateral by Monday morning. The problem is, it's a long weekend. Markets are closed. Bank X can't sell assets to raise cash. They can't access normal liquidity channels. And rumors start circulating. Social media lights up. Financial Twitter is buzzing. Bloomberg terminal chats are going wild. Is Bank X solvent? What's their silver exposure? Are there other banks exposed? When Asian markets open Sunday night Eastern Time, there's panic. Gold and silver futures gap up. Currency markets get volatile. Credit default swaps on major banks start widening. That's the market's way of saying counterparty risk is increasing. By the time U.S. markets open Monday, the question isn't if there's a problem. It's how big the problem is and who else is exposed. Now, here's the good news. Modern financial systems have safeguards specifically designed for this scenario. The FDIC has resolution authority. They can take over a failing bank, wipe out shareholders, impose losses on bondholders, and ensure depositors are protected up to $250,000 per account. There are living wills, which are plans that big banks must file showing how they can be safely dismantled if they fail. There are stress tests that regulators run to ensure banks can survive severe shocks. The Federal Reserve has emergency lending facilities. They can provide liquidity to solvent but illiquid banks. The Treasury has the Exchange Stabilization Fund. In extremis, the government can intervene to prevent systemic collapse. We saw all of this in action in 2008 and again in 2023 when Silicon Valley Bank and Signature Bank failed. But here's the challenge. Those safeguards were designed for different scenarios. 2008 was a housing crisis. 2023 was a duration mismatch and a social media-fueled bank run. This scenario involves commodity derivatives, physical supply shortages, and concentrated market positions. The mechanics are different, the transmission channels are different, and the speed could be different. Let me give you a historical parallel. In 2020, the nickel market on the London Metal Exchange experienced a massive short squeeze. The price of nickel doubled in a matter of hours. It triggered billions in margin calls. One Chinese company, a major player in the nickel market, was on the hook for margin calls they couldn't meet. The London Metal Exchange made an unprecedented decision. They canceled trades. They literally rewound the market. Trades that had been executed at high prices were voided. The exchange argued it was necessary to prevent systemic collapse, but it also meant that counterparties who had legitimate winning positions got their trades canceled. The credibility of the market was damaged for years. Could something similar happen in silver? It's possible. If the price moves so violently that it threatens the solvency of major participants or clearinghouses, regulators might intervene in ways that distort normal market functioning. And once you start intervening, once you start canceling trades or changing settlement rules mid-crisis, confidence evaporates. And confidence is what holds the entire financial system together. So let's walk through the three scenarios in detail. Scenario 1, orderly resolution. A small to medium-sized bank fails. Maybe it has some derivatives exposure to silver, but it's manageable. The FDIC steps in over the weekend. They arrange for a healthy bank to acquire the failed bank's deposits and some of its assets. By Monday morning, depositors have access to their money through the acquiring bank. The derivatives book gets wound down in an orderly fashion. Counterparties take some losses, but nothing catastrophic. Silver volatility spikes for a few days, but then stabilizes. Within a week, markets have moved on. This is the base case. This is what the system is designed to handle. And honestly, this is the most likely outcome. Scenario 2, contagion risk. A major bank with significant precious metals derivatives exposure fails. The failure happens over a weekend when markets are closed. By the time Asian markets open, there's widespread uncertainty about which other banks are exposed. Margin calls cascade across the system. Banks that are fundamentally healthy suddenly face liquidity problems because their counterparties can't meet obligations. Credit markets seize up. Interbank lending rates spike. The Federal Reserve has to activate emergency lending facilities. The Treasury coordinates with international regulators because the exposures cross borders. It takes several days, maybe a couple of weeks, to stabilize the situation. Some hedge funds blow up. Some smaller banks get absorbed by larger ones. Silver prices whipsaw violently. But eventually the system holds. It's messy, it's scary, but it doesn't collapse. This is a tail risk scenario. Lower probability, but the impact is significant. Scenario 3, systemic crisis. This is the nightmare. Multiple banks are simultaneously stressed by derivatives losses. The physical versus paper silver disconnect becomes acute. Contract holders demand physical delivery in unprecedented numbers. There isn't enough metal to go around. Clearinghouses face insolvency. The COMEX or LBMA might have to change settlement rules or halt trading. International coordination breaks down because different countries have different priorities. Currency markets go haywire. Equity markets crash. Credit spreads explode. The Federal Reserve, the Treasury, and international central banks have to launch coordinated interventions on a scale not seen since 2008, or maybe even larger. We're talking potential bank holidays, temporary capital controls, emergency legislation. The financial system survives, but it gets restructured. Trust in derivatives markets is permanently damaged. Commodity trading moves to different venues or different structures. This scenario is low probability, but if it happens, the impact is catastrophic and long-lasting. Now here's what you need to understand. The notional value of derivatives sounds scary. $5 trillion sounds like an apocalyptic number. But notional value is not the same as at-risk capital. If you have a derivatives position with a notional value of $1 billion and it is fully hedged, your actual risk might be minimal. Banks employ sophisticated risk management. They have offsetting positions. They have multiple counterparties. They stress test their books regularly. Regulators review their risk models. That said, risk models can fail, hedges can fail, counterparties can fail, and when markets move in ways that haven't been seen before, all the sophisticated mathematics in the world can't predict what happens next. The key insight is this: the system is robust under normal stress. It's designed to handle individual bank failures. It's designed to handle market volatility. What it's not designed to handle is multiple low-probability events happening simultaneously with compounding effects. So what should you take away from this analysis? First, the probability of a major systemic crisis triggered by silver derivatives is low. Not zero, but low. The regulatory framework is stronger than it was in 2008. Banks have more capital. Clearing and settlement mechanisms are more robust. And the Fed has demonstrated it will act aggressively to prevent systemic collapse. Second, the impact of such a crisis, if it did occur, would be severe. It wouldn't just be about silver prices or bank stocks. It would ripple through credit markets, currency markets, and the real economy. Supply chains for industries that depend on silver, electronics, solar panels, EVs would be disrupted. Investor confidence would be shaken. Policy responses would reshape markets in unpredictable ways. Third, the best defense is diversification and understanding. Don't concentrate risk. Don't assume that because something hasn't happened, it can't happen. And don't panic based on social media speculation. Evaluate claims against evidence. Ask who benefits from spreading fear. Look at what regulators are actually saying, not what random accounts claim they're saying. The silver rally is real. The supply shortage is real. The banking sector stress is real. The derivatives exposure is real. But the narrative that banks are on the verge of collapse because of silver is not supported by evidence. It's a hypothetical scenario worth analyzing, worth understanding, worth preparing for in terms of having a diversified portfolio and understanding financial system mechanics. But it's not an imminent certainty. What we're witnessing is a stress test in real time. The question isn't whether the system is perfect. It's not. The question is whether it's resilient enough to absorb shocks, adapt, and continue functioning. History suggests it is. 2008 taught us painful lessons. 2023 reinforced them. The regulatory architecture, the central bank toolkits, the resolution frameworks, they exist because past crises revealed gaps. Those gaps have been partially filled. Will there be another financial crisis someday? Probably. Will it come from silver derivatives and a bank failure colliding? Maybe. Is it imminent? The evidence doesn't support that conclusion, but the possibility is non-zero. And understanding the mechanics, the transmission channels, the safeguards, and the failure modes is valuable, whether the crisis comes tomorrow or 10 years from now. The financial system is complex. It's interconnected. It's fragile in some ways and remarkably resilient in others. Our job as informed participants is to understand that complexity without succumbing to either complacency or panic, to evaluate risks based on evidence, to diversify against worst-case scenarios without betting everything on catastrophe, and to stay informed as markets evolve. So that's the analysis. A major bank fails while silver is at $79. What happens? It depends on the specifics, the size of the bank, the nature of the derivatives exposure, the state of the broader market, the speed and effectiveness of the regulatory response. In the best case, orderly resolution. In the worst case, systemic crisis. In the most likely case, something in between, messy, scary, but ultimately contained. The silver story isn't over. The banking sector stress isn't resolved, and the derivatives markets will continue to be a source of both liquidity and risk. Stay informed. Stay diversified, and understand the difference between analyzing risk and predicting catastrophe. What's your take? Which scenario do you think is most likely? Let me know in the comments.